how bankers think? They want to control your money. They want to control how the money flows, right? If you want to become your own banker, you need to start thinking like a banker. So you probably already saw this book. This book is titled Become Your Own Banker by R. Nelson Nash. Nelson was a individual who discovered this concept in his life, and the system is being used to create a family bank. We in Ascendant Financial educate and empower North America about how the infinite banking works and how this can work for you. This is most importantly. And we coach one-on-one, and we also coach in group settings where our clients get together and we give them tips and advice on how to use the process. We separate the product from the process. This is important to understand. The product is a product and the process is a process. Today, we're going to be talking about what is unseen about the process itself, not about the product. However, we will also talk about the product. Everything begins with the way you think. So R. Nelson Nash, in his book, he's talking a lot about the human behavior, right? How your behavior can actually help you or prevent you from achieving great results with this concept. He's saying that you need to think like a banker. So how bankers think? They want to control your money. They want to control how the money flows, right? If you want to become your own banker, you need to start thinking like a banker. This is critically important. Money has to flow, and it is flowing somewhere. So in the middle of the screen, we see it's you, right? And you have income, the income coming into you, and then you have all those amazing bills and expenses you need to pay for. Lines of credits, credit cards, appliances, house remodeling, furniture, vacations, clothes, property taxes, foods, boat payments, healthcare plans, investments, medications, you name it. A lot of payments to do, a lot of bills. We open up the envelopes and we need to pay those bills. How do we usually pay for those expenses? We just cut check or we swipe credit card, right? So money is flowing away from you. This is super important to understand. Now, when money does flow away from you, then all the bills are paid. You have all those stuff, you got those services, and the money flew away from you. Where's my money, you may ask? And you may look at your wallet and you say, there's no money left. Where's my money? So add up all those payments. What do you have? So how much of the money you have today from those payments? Everyone got your money, but where's your money? And you have zero because there is a financial leakage. You are already familiar with the function called banking. You know how this works. You know that you need to make deposits and then pay bills and take withdrawals. But the problem is you're not controlling it. Becoming your own banker is all about creating your own private family banking system. So when we refer to page 11, that's the page in Nelson Nash's book. Once all this money is paid for those expenses, then everyone has your money. But what you need to do, you need to make sure that the money flows to you, not away from you. You need to change the direction of this money, and so that this money comes back to you. And at the same time, all those bills and expenses are paid. So you need to achieve two objectives of getting all those expenses paid that you need and keeping the money. How can you do that? Give it close attention and it will make a radical improvement in your financial future. Here's a fact. You have to exchange money to buy things that you need, right? There has to be a transaction. There has to be money paid and money has to flow. There's two methods that you're familiar with to buy things you need. One method is pay cash. So when your income comes in, you have to put it somewhere and then you're saving this money. Or other method is borrowing. If you don't have money, then you swipe your card, use other people's money, but that comes with the cost of paying interest. You may realize, you may not realize it, but both of these methods actually are financing. And if you're paying cash, you're losing interest. If you're borrowing money, you are paying interest. So in both cases, you are financing. How are you losing interest if you're paying cash, you may ask? Is because you are simply because this is a lost opportunity for you. So your money could have been used to invest and earn interest, which is not. If you pay cash, this money is permanently transferred away from you. When you borrow money, you're paying interest. Here's the problem with these two methods. Both of them, pay cash and borrow money, they involve permanent transfer of money away from you. So there's two methods how people go about paying for things, right? So the debtor, if he doesn't have money, he takes the loan and goes into negative, and then he starts making those payments, and those payments lead to zero. And when the loan is paid off, then he paid the principal and interest, and the money is permanently transferred away from him. And then he needs to buy something again. He goes directly into debt again. It starts making payments and then goes up back to zero. And then the cycle repeats and repeats and repeats. So the debtor mindset is constantly paying interest to someone, and that interest is someone else's profit or someone else's asset. So if you're a saver, then you're doing pretty much the same, but first you need to save money because you need to first save it. So you first make payments, and then once you have enough, then you buy things for cash. And you transfer this money away from you permanently. All this cash has gone. You can never use it again. And you go back to zero, and then you start saving again to buy things of life. And when you do that, you lose interest because this cash would have been used to make money for you. But since you paid it, then it's gone. The problem is never the problem. The problem is how you think about the problem. So what is the problem there? The problem is you're able to buy things you need of life, but all your money is gone. You're doing all the work, but someone else is getting your money. Your money is gone forever. Money is being permanently transferred away from you and your family. Now we talked about the problem. Let's talk about a solution. The solution is creating your family bank. And this all is laid out in Nelson Nash's book, Becoming Your Own Banker. It's $29.99, and we send it to you from Edmonton. You will receive it in a couple of business days. You may be wondering, how exactly does the process work? The process of working with us. So you're here at the start. If you want to learn about this, you first need to do a first step, understanding the process. The next step you need to do if you want to solve this problem in your life, if you have a desire, if you have a burning passion to get out of the financial prison, you need to do it with a coach. Your coach will need to create a roadmap. So first, your coach will need to understand your current situation and your goals and objectives, and then create a tailored roadmap for you, because it is not something like a cookie cutter. It's not something that is the same for everyone. It has to be tailored to your specific objectives and based on your specific financial situation. And then once you want to get started, then you need to qualify for life insurance, because this is based on the product that is called participating dividend paying whole life insurance product. And you need to qualify from a health standpoint. If it's not you, if you cannot qualify, that's completely fine. There has to be someone in your life who should be the life insured. You can be the policy owner, but that person can be the life insured. So if you have a beneficial interest in someone in your family or business, then that person can be the life insured. Once the policy is approved, you need to settle it. Once it is enforced, you start implementing the process. That's where the process of banking starts. And you need to see your coach regularly. So your coach is your guide in your journey to using the tool. Your coach is a free addition to your process, right? So the coach is basically there to support you and to guide you how to avoid mistakes in human behavior and how to prevent from doing mistakes and achieve your financial goals in the most timely manner and the most efficient manner. There's no end to this process, right? So at the end, graphically, I just put expand. So you will naturally want to expand your system, because when you see how the system works, you will want to open a second policy, a third policy, a fourth policy. So you may be wondering, how does it work? Show me examples, show me numbers. Let's talk about recapturing the interest. Fun exercise. When you're making financial decision to buy, to invest, or borrow, what is the first thing people look at? Is the interest rate. So first thing people are looking at is the interest rate. For example, look at the money invested in GIC. GIC is a basically bank deposit, right? It's a term deposit for a specific term. And in this case, it's $30,000 and it is earning you 7% per year. So the rate is 7%. Now you need $30,000. At the same time, you open the GIC, but you realized a couple of weeks later, oh, I need cash. I need 30,000. So how can you go about it? You can use your cash and withdraw your GIC and stop compounding, stop growing your interest. Or you can actually take a private loan and you borrow at 12%. So you can keep your GIC growing, compounding, and you don't stop it. And at the same time, you borrow at 12%. And you may be looking at the rate and looking, you know what, it doesn't make sense. So my money is growing at 7% and my loan is 12%. Probably doesn't make sense, right? But let's look closely. In this case, we are looking at the loan, principal and interest for 4 years, $30,000. Which option would you select? Using your cash which is growing at 7% and stopping your compounding, or borrowing at 12% and using someone else's money. Private loan. So how it is structured is $30,000 a principal, 12,000 is a rate, interest rate. The duration of the loan is 48 months, which is 4 years. Monthly payment is going to be $790.02. And then total amount of loan repaid is $37,920.72. That includes $7,920.72 of interest paid. So GIC is growing exactly the same term, 4 years, 7%, and it is compounding. And because of compounding, it has gone up to $39,323. So the interest, the profit is $9,323. So only looking at the rate doesn't help because it is not giving us the whole picture. 12%, the number is higher than 7%, the number. But when we look at the volume, we see that the amount made is actually higher than the amount paid. If we only look at the rate, the amount paid looks higher. But when we look at the volume is actually higher. Volume earned is higher than volume paid. So the teaching point here is you don't need to only look at the rate. Always look at the volume of dollars that you're going to either earn or pay. It's about the volume, not about the rate. So you need to think about things differently. So creating family bank and unlocking the infinite banking concept. What does it involve? It involves keeping your money in the family so that all the interest that you are going to be paying to someone else, to banks, and maybe lose interest that if you're paying cash, you are retaining that interest inside of the family. And today we're going to be talking about examples on what you can achieve with doing that. How do you recapture the interest? What does it even mean to recapture the interest? When you're paying cash, like we said, you're losing interest. When you're borrowing money, you're paying interest. But infinite banking is all about recapturing interest so that interest stays with you. Wealth creator is, as opposed to the debtor and the saver, you are doing two things at the same time, right? So you're putting your deposits to work. It is growing, so you're saving money. And when you need cash, you're actually borrowing against your cash value. You're not touching your money, you're not using your cash, but you're using insurance company's money to borrow against your capital. This is important to understand that when you borrow from the tool, you're not touching your money. You're borrowing insurance company's money. Yes, you're paying interest, but this interest is a profit for the insurance company, and the insurance company will pay you dividends. So essentially, this money at some point is coming back to you. So the tool is participating, dividend paying whole life insurance. And the components of this contract is there's four main components. There's a premium. This is what you decide what it has to be. Some people start with 5,000 per year. Some people start with 50,000 per year. Some people start with 100,000 per year. So it's really based on your income and your comfortable number. You need to decide how much you want to put into the policy. Don't look just at the death benefit component of it, right? Think about the premium as of a deposit. There's also a death benefit. So the death benefit is received tax-free by the named beneficiary upon death of the life insured. So whoever the life insured is, the death benefit will be received tax-free in Canada, and it goes directly to the named beneficiary upon death, and it is tax-free. There's also cash value. So the cash value is your capital inside of the policy. It increases in value every day, tax-free. There's no capital gains. And the total cash value of the policy must equal the total death benefit by age 100. So this is important to understand. It is a contractual guarantee that by age 100, your total death benefit must equal your total cash value. That's why your cash value is going up every single day. And that's insurance company's job to increase cash value every day. And the fourth component is a dividend. As I said, this policy is called participating. And what it means is this policy participates in the insurance company's profit. So it is your share of the visible profit from the life insurance company. So the premium has two main components. There is a required premium. That's the minimum that has to come every year from your income or your savings. You have to pay this required premium every single year, no matter what. By the way, at some point, you may use your dividends to actually pay for this required premium. You don't have to pay for life, like forever. You have to stick to this number. No, at some point, if you feel like you want to stop paying, you can actually use your dividend to pay for this required premium. And the second component is deposit, additional deposit option. So additional deposit option is optional payment that if you do pay it, then you're adding more efficiency to your policy. Let's look at how it is structured. So in this example, this is a person who is male, 45 years old. You see, these are the ages, 45, 46, 47, and all the way to age 100. So when he starts paying, then his starting death benefit is $200,000. That's his life coverage, whole life insurance. Starting death benefit is $200,000. He decided to pay premium $10,000. This premium has two components. The required premium, the base, is $4,000. So it's not 10, it's 4,000. And 4,000 is servicing this death benefit of $200,000 every single year. So he has to pay 4,000 no matter what. And the optional amount is 6,000. So if you combine 6 and 4, that's $10,000, right? So when he pays 6,000, something significant happens. This money is being used to buy more death benefit. The contractual guarantee is that your total cash value and your total death benefit must match at age 100. So there's cash value accumulation that's happening inside of the policy. Let's imagine he only started paying 4,000. So the insurance company will be giving him daily capital so that this capital matches 200,000 by age 100. So if we gives them more money, 6,000 more on top of 4,000, then he increases this goal for the insurance company to grow money. Now, instead of $200,000, he purchased another 20,000 of additional death benefit. And that's one shot of insurance. So he purchased this paid up additions and there's no additional payment required. It's one purchase of insurance. He paid 6,000 and he purchased 20,000. So in this example, his death benefit increased from 200,000 to 220,000. At the end of the year, there is a dividend, which insurance company declares. And when the insurance company declares the dividend, it is being paid to all policyholders. And you can actually take this dividend as cash. But what we do and what our clients do, we teach our clients how to use dividend to buy more paid up additions. So in this example, the dividend is $1,000. It was used to pay $10,000 of paid up addition. So again, this is one purchase of insurance. It doesn't require any future premiums. And the total death benefit increased from 200,000 to 230 because of this paid up addition and this paid up addition. Year two, he pays 10,000 again in year two. So 4,000 goes directly to service the base, the same exact base. And then because he already paid 6,000 again on top of 4,000, it purchased more paid up additions. Again, I don't know what number it will be because it may change from year to year because he's getting older, right? But he will buy more paid up additions every single year with this optional one-time premium. And then at the end of second year, there's a dividend again. So he purchased more paid up additions. And it's like a layer on a cake. Every year, there's another layer on a cake of buying more and more paid up additions. As you see, the total death benefit increases. And remember, total cash value and total death benefit must match at age 100. So like I said, there's a equity that insurance company is creating inside of this contract, and you can borrow against that equity. And each of those additions, paid up additions, so these are the blue ones, I illustrated they are actually coming from the one-time premium each year. So year 1, year 2, year 3, year 4, and so on and so forth. He will be adding those paid up additions. In each of those has its own cash value. So the total cash value must increase. So the total cash value increases every single year because of these additional paid up additions. And the dividend also buys paid up additions, and each of those additional paid up additions has cash value inside. So the total cash value looks like this. The white line is the total cash value. That is the amount of cash value of the base and cash value of all those paid up additions. Remember, it must match total death benefit by age 100. That's why we're creating this amazing compounding effect. The family banking system is not limited to just one policy. It can be a system of policies like in my family. I have 12 policies right now. For example, just to illustrate how the total death benefit and total cash value works. So we laid out 3 policies in bank 1, that's policy number 1, bank 2 is policy number 2, bank 3 is policy number 3. So you making those deposits, you're making those premium payments into the family banking system, and the total death benefit increases and total cash value increases, and you borrow against the cash value. So the policy loan is always 90% of the cash value. Every year and every day as you put these premiums in, your cash value increases each day and the policy loan available increases each day. And it goes like this. Every year, the death benefit, total death benefit increases, the cash value increases, and the policy loan is always 90% of the total cash value. And you borrow, that's your borrowing ability from your bank. And when you borrow, it is on your terms. You control their payment schedule, you control the term, and many other parameters. And when the cash value goes up, this is what happens. So as you see, policy loan is always 90% of the cash value. And this what happens at age 100. As you see, at age 100, your total death benefit and your total cash value match. And the policy loan available increased because it's 90% of this amount. And let's assume that the death happened at age 100 or maybe even later. So there's always a death benefit because the insurance company has to pay in all cases. It's not if, it's when. It doesn't matter what happens in the financial world outside of these policies. The cash value keeps increasing every single day. That's the beauty of the system. When the stock market goes up, the cash value in your policy goes up. When the stock market goes down, the cash value in the whole life policy goes up. When the crypto goes up, the cash value in the whole life policy goes up. When the crypto goes down, the cash value in the whole life policy goes up. Interest rates, right now they're going up. Guess what happens with the cash value? Goes up. Interest rates go down. What happens with the cash value? Goes up. So the family bank works, and you just need to get going. You just need to get started. And let's look at 4 family banking case studies. So becoming your own banker, the most important words are your own. So because it's on your own terms, it's your own banker. Each family is unique. Family bank is unique. There's no such a thing as, as a cookie cutter. So it has to be designed and be able to achieve your financial goals. Every family is different, so every family banking should be different too. And the goals that very often hear from our clients, that clients name their objectives and goals is, for example, to finance investments. How do I finance investments? By multiplication by my wealth. How do I recapture my debt? By eliminating my debt. How do I finance family comfort? Buying cars, going to vacations. How do I keep taxes away from wealth? And creating generational wealth transfer to the next generation, to my children and grandchildren and many future generations. Let's look at an investment example. So invest less and earn more using IBC. So for those who invest, let's meet Corey. So Corey is our client. When he met with an advisor, he was age 38. He was a full-time investor. He really got excited about rate of return over 20%, and he loved the long-term benefits of the infinite banking concept, but he was struggling to understand how the short-term benefits of the infinite banking work. He was asking, hey, show me how it benefits me today in the short term. And the problem is not the problem. The problem is how we think about the problem. So by improving one thing, but not focusing on what you buy, but how you go about buying it, everything that you do financially is a measure against how someone else is doing. If you're doing well, okay, compared to who, right? If you're doing not so well, compared to who? So let's compare. Let's see how we can enhance the transaction for Corey by just changing one thing from him is the process. We're not going to change his objective. His objective is getting 20% rate of return on his investment. We're going to change his process of accomplishing his objective. So what is his objective? Is getting 20% rate of return. Method number 1. So he has 2 options. Use his own cash that he has to save up first in a bank. Method number 2, other people's money, OPM. You may have heard this term. Using a HELOC, it's home equity line of credit, when your house is a collateral. So Corey's house is a collateral, and he can borrow against the equity in a house by borrowing from a bank at 6% and investing that amount. Method number 1 uses his own cash. So he uses $20,000 of his own money in this example, and 20,000 is invested and making 20% rate of return. The total gain is 4,000. Again, 20,000 by 20%, that's $4,000 is a capital gain. Method number two is using other people's money. HELOC, $20,000. He doesn't need to save it. He doesn't have money, but he uses bank's money, and he borrows and invests in exactly to the same exact place in exactly the same investment, and the total gain is the same. But in this case, he has to pay interest. So the interest bank charges is 6%. That's $1,200 per year. So the net gain per year is 4,000 minus the interest he pays, 1,200 is $2,800. Still pretty good, right? So you did good. You did really, really good. Because if you look at cash on cash, you will see that he actually got more than 230% profit on his out of pocket. And then he got 2,800. That's a big profit for him. Now let's make it even better and much, much better by changing one thing, that is a process. Using Family Bank. So he takes $20,000 and instead of putting it to invest, now he wants to use his dollars in two places at the same time. He puts this money into his own banking system as annual premium. So 20,000 is a premium for policy. So his starting death benefit, because it's a life insurance, is $400,000. So if he puts 20,000 and tomorrow he gets hit by a bus, guess what happens? How much will his family get? Is $400,000, right? Because it's a life insurance. If he doesn't do that and he puts only his cash into the investment, how much will he get? His family will probably only get his investment, which is $20,000, right? So by doing only one thing, we already accomplished there is a death benefit, which is much more than his initial deposit. So because this policy was designed properly, there is a cash value immediately. He doesn't have to wait for it. And he can borrow 10,333 immediately from the policy. Again, he's not touching his money. He's using insurance company's money, and he takes policy loan. The daily cash value growth is $8 per day. We've already looked at why the cash value is growing is because insurance company has to match your total death benefit and your total cash value at age 100. Remember, he's 38 years old. His total death benefit, his starting death benefit is $400,000, and insurance company has to give him $8 per day in order to match this number by age 100. So in the first year, it's $8 per day. In the second year, it will be more. Third year, it will be more and more and more. Immediate loan available from insurance company is $9,300 because it's 90% of the total cash value. Total cash value is $10,333. If you multiply it by 90%, that's $9,300 cash. So insurance company charges interest 6.2%. And method number three, using Family Bank. So he uses a policy loan of $9,300 to invest, and he puts exactly to the same investment and making 20%. So he invests less cash than initially. Initially, he wanted to invest 20,000. Now he invests 9,300. So the gross profit is only 1,860. Interest paid to the insurance company is 576 because insurance company is charging 6.2%. So the net profit is, you need to subtract the interest from the profit, so it goes down to 1,284. But wait a second. You said that the Family Bank would be better. Why is it lower? Let's compare all three. When he uses his own cash, the profit is 4,000. Whose capital is he using? His capital. The final outcome is 4,000. Second method, HELOC, home equity line of credit. So he uses exactly the same amount, and the profit is 2,800. Because he needs to pay interest to the banks. Whose money is he using? Bank's money. Now his profit is less. Family banking system. So he puts 20,000 into a premium and he borrows as a policy loan. And whose capital he is using? He's using insurance company's money, and his profit is 1,284. It seems very low, but don't forget about the daily growth in the policy at $8 per day. And in 1 year, that will create that 2,920 tailwind that he created by doing this simple change in his process. So now you need to combine 1,284 profit with the tailwind that he created in his Family Bank. Now his outcome is 4,204. Is it better even than the cash? It is better, right? And on top of that, he already has insurance in place. So God forbid anything happens to him, his family will be well protected. In terms of taxes, how much does he need to pay for the method one. All of it is taxable. All 4,000 profit is taxable based on Canadian tax rules. Home equity line of credit, how much is taxable? Only the profit is taxable, right? And how much is taxable if he does infinite banking? It's only $1,284. So not only he made more money, $4,204, but he also will pay less taxes. He only changed one thing and the dramatical increase in the outcome. And remember, he only invested less than 50% of the initial deposit, right? Only 9,300 was invested. And the amount is so significant. The profit is so significant. And next year, by the way, when I mentioned $8 per day, next year this amount will increase. So next year his profit will actually be much, much better. Nelson said that you cannot actually get a better rate of return investing into anything without first controlling financing function using the family bank. When we talk about money flow again, who is getting the money now when you open the policy? You are getting the money. Money is now flowing to you, not away from you. The most common question we get is, can you connect me with the right person in your team to take a look at my financial situation and show me how I can set up my own family bank? And the answer is yes, of course. So if you would like to get started, you can text the word schedule to number 780-809-4599. I know, and you should know deep down that you're capable of becoming your own banker. So we looked at investment. So eliminating debt, how does that work? Meet the Osborne family. So their names are Mark and Alicia, and their daughter is Sasha. They are seeking total and absolute control, and they want to eliminate their debt. So these are their objectives. So their objective is to become debt-free as soon as possible. They want to eliminate all consumer debt except for the mortgage, because the mortgage is not so easy to get rid of, but the consumer debt they can actually eliminate. So Mark is 37-year-old. He's an engineer making $105,000 per year, lives in Ontario. His wife is Alicia. He's 36 years old, nurse, works part-time only, and makes $43,000 per year. So they have one child, 20-year-old daughter Sasha. The total household income is $148,000 per year. So they acquired $46,000 in consumer debt, including a car loan, $35,340, and a credit card debt, which is $11,000. Their combined payments are $1,177, which includes payment for the car, $761 per month, and $419 per month they're paying for credit cards. Not only the interest, but they also want to slowly pay it down to zero. That's why they're actually paying more than just in interest. And both these payments come to $1,177 per month. They also have discretionary income left each month of $2,000, and they actually invest into TFSA. And the balance for TFSA right now is $29,000. They're not happy about how it is going up and down all the time. So do you think they're moving ahead or behind? So their assets are $29,000 in TFSA, and this asset is not actually giving them monthly cash flow. Their liabilities is $46,340, and monthly payment is $1,177. Do you think they're moving ahead or behind? Behind, because there's a leakage. Leakage is huge. It's $1,177 per month from their net worth. That's like a second mortgage, right? So his objectives are be debt-free without working any harder, taking on any additional risk, changing his cash flow. He wants to keep the cash flow, and without losing control of his money. He doesn't want to leave his family in debt if the unthinkable happens. So he wants to make sure that all of these objectives are met, and he wants to eliminate his debt as soon as possible. So implementation, let's see what the Osbornes did. They have two main debts, $35,340 and then $11,000 a credit card. So their total payment is $1,177, and that's how much is per month they are living. So the upper part is the current situation, and they are starting two policies, $12,000 each. Total premiums is $24,000. When they do that, immediately the cash flow that's created in the policy is $14,950. They can borrow 90% of that as loan available. So 90% of $14,950 is $15,455. That's how much they have available to borrow. They don't need that much, but they need 11,000. So that's what they did. They borrowed from this policy and they eliminated credit card debt immediately. And that will help them actually to eliminate the payment of $419 per month. So 400 per month is recaptured now. What do they do with this freed up cash? They actually put it back into the policy. So there's a loan outstanding in this system, in the family banking system, loan outstanding in two policies. And each month they're actually redirecting these payments to loan available. Because they have policies in force, the cash value is increasing each day. And the growth into policies is about $15.50 per day. So if you multiply 1550 by 30 days, that's 465 days per month. So the cash value increases because the insurance company has to match the total cash value to the total death benefit. And the available amount to borrow also increases, it goes up because the cash value increases and also because he is paying back these policy loan payments. So these are payments back to his system. So loan available, month one is 28.74, month two, 36.52, month three is 44.33, month four, 52.15. And if you look at the increase in the loan available, you will see that, for example, between month three and month two, what is the increase? $781. Think about it. He is paying 419 and the increase is 781. So he can reborrow this amount immediately if he wants to. Next month, he pays 419 again and increases 783. Next month, he's paying 419 and increases 785. So it's actually going up. And very fast, his cash value available and loan available is going up. And by doing that, he increases his total loan available. And he's still paying his car loans, right? So these amounts, 758 is the payments he's still paying to the banks. So he didn't change his cash flow. It's exactly the same. So if you combine 758 and 419, that's exactly 1177. So he's still paying exactly the same amount, but two different banks now getting this amount. So 758 is traditional bank gets, and 419 his own banking system is getting, right? By doing that, his car loan naturally goes down, and in month 15, the car loan is 25,955. By that time, he already made a second premium payment because remember they're saving 24,000 per year and they're redirecting that money into the system instead of putting this money into TFSA. Now they actually putting this money into a system, and by month 15 they have enough to actually recapture the remainder on the car loan. That's exactly what they're doing. They're borrowing 25,955 and the loan outstanding in the policy increased from 6,000 to 31,000 because of that. Now what they can do, they freed up the payment. The payment is now theirs, right? They can do whatever they want with it. They can spend it, but they're smart. They're not spending it. They want to redirect it back to the system. And these payments of 1,177 is returning back to the system and increasing the loan available in the system. Think about these payments that he used to be making for a car loan. How much of that money is readvanceable for him if he wanted to borrow again? None of it. So how much is readvanceable if he is sending it to his bank? All of these are readvanceable. So the difference between month 17 and month 16, it's 1832. Remember, his payment is 1177 and he can borrow 1832. Where else can you pay 1877 per month and get access to 1832? Next month, he is paying 1177 and he get access to 838 because his policy is growing and increasing very fast and he is actually paying less to the insurance company. That's why his available amount actually goes up. By doing that, in 15 months, he has no outstanding loan at all, only his mortgage. And all this money, 1177, is readvanceable, is now the money that he can put back into the system and use it as deposit into the family banking system as a loan repayment. Yes, he still has outstanding loan, but because he's putting all this money back into his own system, the loan outstanding in his system, in his family banking policy is actually going down. And it will take him some time to actually be free of the loan. By month 44, the policy loan will be completely paid off. As you see, it goes down to zero, and all this amount that he recaptured when he started doing that, the amount of interest he recaptured was 2581. And if we compare this amount with the amount that increased in the policy, so in the cash value, so the cash value increased by 74.46. He paid interest to insurance company of 2581, but the policy increased by 74.46. By the way, this number is net of the premiums he paid in the next 2 years, and also it is net of the initial amount of 35,000. So 35,000, that's how much initially was his cash value. And I'm comparing month 15 and month 44. So month 44, he has 91,000 minus 24,000 minus 24,000 and minus 35,683. That's increase of 74.46. So do you see that he actually has 3 times more money compared to what he paid interest to the insurance company? It is incredible. So total loan paid to the infinite banking system is going to be 33.94. So he took the actions and they started 2 policies, 12,000 each on both of them, on Mark and Alicia. Total premium is $24,000. Policy loan available on day 1 was $13,455. He took a policy loan, $11,000, and paid off completely his credit card debt and recaptured $419 and redirected back this payment back into the policy loan repayment. After that, it took him another 15 months to recapture the complete car loan by creating cash value in a policy and making car loan payments. He had enough money to take out a loan and completely paid off. And now all his payments are now redirected back into this policy. And 44 months later, he is completely debt-free except for the mortgage. So that's your capture summary. All debt was gone in 15 months versus initial 53 months. So initially, it would have taken him 53 months without infinite banking system to actually naturally pay down the car loan and the credit card debt. That's more than 3 years worth of payments. Total premium dollars put into the policy. So premium, he totally put 96,000. So that's 24,000 times 4, that's $96,000. Total policy loans taken, 36,955. And total debt recaptured is 46,340. And they're happy they're now consumer debt free. So interest capitalized by the insurance company. So they totally paid interest to the insurance company, $33.94. And the total debt recaptured plus the total interest is $49,734. And now they have $1,177 per month, beginning of month 16, to use for policy loan repayments. So he's not spending that money, and they're not spending this money. They're actually redirecting all those payments, the same payment, not changing his cash flow, to redirect back to this policy loan repayments. By month 44, the policy loans are fully repaid, and they have access to $80,900 to borrow again. By doing the debt recapture, they have access to all family equity without losing interest. So recap, this what graphically it looks like. Initially, they did not have cash value in their policies. They only had family debt and monthly payments. By starting the family bank, they started growing cash value. So they don't want to wait until the debt is gone. They want to do it at the same time. They want to create cash value and use that cash value to eliminate debt. And that's how this works. So the family debt going down and monthly payments going down, cash value at the same time going up, and the repayment recaptured are also going up. And in 15 months, the total cash value increased and all payments are recaptured, and family debt goes to zero and monthly payments goes to zero. But after that, they continue doing what they're doing. They continue actually paying back the policy loans, redirecting the payments back to the system. So family bank created and helped them to create cash value and recapture the payments. So Mark and Alicia increased their net worth by eliminating debt and using family bank. Let's look at financing cars and any other things that you may need in life. So how do we go about financing family comfort? Meet Vadim. Vadim is actually my son. So he was 16 in 2021. He was a student and he's still a student. He goes to school, grade 10. This September, he goes to grade 12. Worked part-time, only works in summer, needs a place to save and grow his money while he's finishing the school. He was introduced to IBC in 2021. He actually saw Infinite Banking book on my table. He said, Daddy, can I read it? I said, absolutely, go read this book. His goals were, he wanted to take control over banking function for financing cars. So he was so excited because he knew that it is a unique way to do finances as opposed to what his peers are doing. So he was also learning to drive. His first car purchase was coming up in 2023. And he also was saving money for education. He needed to save some cash to go to university, and he needed a place to save his money. So he needed a warehouse for his wealth. And he also wanted to use this in the future to build his retirement income without any risk. Some facts. So he worked part-time only in summertime because he is a full-time student. He worked 8 hours a day. And he wanted to save about $3,000 to $9,000 per year. He had no life insurance, and he had about $10,000 in cash assets. So here's what Vadim did. So he started a policy in 2020, and he put a premium of $3,000 per year. So his starting death benefit was $102,000. Remember, that's male, age 16. Policy premium is $3,000 per year. His father is the policy owner for Vadim. So because he's 16, I was the policy owner for him. So I also had a policy too. So my policy was opened in exactly the same year, 2020, and the premium was $14,000. So my death benefit is $222,000, and I added a $1.5 million term rider because if I would pass away, do you think $222,000 will make it justice for my family? Probably not, right? So I added $1.5 million term rider so that my total starting death benefit is $1.722 million. If I die next day, $1.72 million would have definitely helped her to feel financially secure. Fast forward 2 years to 2023, Vadim decided to buy Honda Civic, and the price tag was not so high, $8,500, which is a pretty decent car. What were his options? So he could use cash or finance it through a bank or lease it. But he decided to actually use his policy. So the cash value in 2 years, he paid two premiums in 2 years, 3,000 plus 3,000, right? So his cash value in this year was $4,000. So in my policy, the cash value was $42,000. So daily growth in two policies together combined was $17 per day. The capital required to purchase the car was $8,500. The death benefit on Vadim was over $123,000. So remember, his starting death benefit was $102,000. 2 years later, it's $123,000. Why? Because he paid more than a minimum, and that's why he purchased paid up editions, and that's why his total death benefit increased from $102,000 to $123,000. Death benefit on myself increased from $1,722,000 to $1,800,000. When you do policy loan, it does not impact cash value growth. When you take a loan, the cash value grows at the same speed, at the same race, I would say the pace, right? So exactly the same growth. You're not interrupting the growth because the policy loan is not really connected to the cash growth. You're just borrowing against it. It does not reduce the death benefit while the person is alive. Doesn't negatively impact future dividends. The loan is not impacting future dividends. See, the dividends will be increasing every year. It does not show up on your credit report. It is a private loan between two entities, between insurance company and the policy owner. At death, the outstanding loan gets deducted from the death benefit. So if I would die the next day while I took a loan, then there would be a policy death benefit in my policy, and the outstanding loan would have been subtracted from my death proceeds, and my wife will receive a net death benefit, net of policy loans. In 2023, daily cash value growth in a policy is $17 per day. So policy initiated for Vadim was $3,500 because that's how much he could borrow. And he received it in 7 business days. Policy loan initiated for myself was $3,000. I received it in 5 business days. So if you combine, it's not still enough. It's not enough, right? So I could have done more, but he actually decided to use his tax refund. He received the tax refund, and the difference was actually used from his tax refund. So the loans were pooled together to buy a car. So daily interest charged by the insurance company is $1.16 per day. That's the interest on the combined loan. The interest rate is 6.5%. So 6,500 combined loan, 3,500 from his policy, 3,000 from mine, by 0.65 divided by 365 days. That is $1.16 combined. And let's look at the growth. So insurance company is charging me $1.16, but they're giving me $17. In 2023, we pulled policy amounts together for $6,500. Vadim decided to pay back policy loans to insurance company at $300 per month for 24 months. Me and Vadim, we decided that Vadim is paying me first. And once he paid off my policy loan, then he will start paying off his loan. That's total and absolute control over finances. So two free individuals are doing banking business together and are not depending on the system, banking on their own terms. And it's 24-month financing. Monthly cash value growth into policies is 510. Monthly repayment is $300. So monthly interest is $34.80. So if you multiply 116 interest per day by 30 days, that's $34.80. And the monthly transaction looks like this: 510 is monthly growth combined with a monthly repayment of 300 and minus the interest on a policy loan. So 775 is readvanceable if Vadim wants to buy something else. So Vadim is going to make extra 8 payments after he paid me and he paid his own policy loan to replenish his savings. So the tax refund is actually his savings. He doesn't want to let it go. He wants to actually replenish it. And that's also banking. So total payments planned will be 24 payments for the policy loans and 8 additional ones, 32 payments. These extra payments will go directly into the policy as well. So the question I have for you is, where else can you pay back $300 per month and have access to 775? It doesn't exist nowhere else. That's the question I just asked. And 775.20 is a new amount that is available to them after each monthly payment. Let's look at fourth example: keeping taxes away from your wealth. Generational wealth transfer. Mark and Alicia and their daughter Sasha, they have 2 policies, $12,000 each, and the total premium is $24,000 each, right? So 12,000 plus 12,000, that's $24,000. That's the total premium. By the way, they decided not to pay it all, years until they die. They decided to actually stop in 28 years. So their objectives are, they have 4 financial objectives, right? So they need to finance family vacations. That's about 10,000 every 2 years. They love to travel. They want to spend 10,000 every 2 years. They may actually spend 5,000 each year, or they may go to vacations or travel every 2 years and spend 10,000. They want to finance Sasha's education. In 7 years, she will be 19, and the cost of education is $100,000. They also wanted to buy a house for Sasha. So they may not have enough because the policy would not be compounded enough to buy a house outright, but they will at least have a down payment for her to help her with the mortgage and get a better mortgage price with the bank, and also skip the CMHC fee. That's additional money that you're going to pay if you don't have a down payment. And they also want to achieve passive income at 67 years old. They want to receive $3,000 per month each, so $6,000 minimum per household when they want to retire, and that's after taxes or free of taxes. And they want to receive it for 24 years from age 67 to age 91. That's assumed mortality, and they want to use this policy only. They also want to leave a legacy to Sasha and for future grandchildren, which will have. And they want to do this tax efficiently. Let's look at some numbers. They have 2 policies, 12,000 each, 12,000, 12,000, and they're not paying all the way through. They're actually paying for 28 years, and then they stop. His age is 37, so these are for year 1, year 2, year 3, and then this is Alicia's ages. These are Sasha's ages. So in 1 year, she will be 13, in 2 years, she will be 14, and so on and so forth, right? So cumulative net outlay. So this is how much totally they paid and from beginning, right? So year 1, they totally paid 24,000. Year 2, they totally paid 48,000. Year 3, they totally paid 72,000, and so on, right? So as they paid, so they will pay for 28 years, and cumulatively, they will end up paying $672,000 premiums into these 2 policies, right? Again, please bear in mind that you don't have to start policies with exactly the same numbers. Your numbers may be different. Your numbers may be higher or lower. It doesn't matter. What matters is your financial objectives and your income. You may start with 5,000 per year. You may start with 1,000 per year. You may start with 100,000 per year. It's just going to be different timeline for yourself, right? So what they want to do, so the total cash value in year one, immediately as they paid 24,000 is going to be 20,459. And available to borrow is 90% of that, which is 18,413. They want to finance vacations. Can they borrow 10,000 to go to vacations and pay it back on their terms? The payment is 461 per month for 2 years. And then in 2 years, they recycle and repeat. They take a policy loan again. So this time they have 61,700 available to borrow. Can they easily borrow 10,000? Absolutely. Can they go to vacation? Absolutely. Can they go more to vacations? Absolutely. But they just want to keep it simple. They want to borrow 10,000, year 3, pay it back in 2 years. Year 5, they have 110,000. They can borrow again and pay it back on their terms. Now this time, they want Sasha to actually go to university. When the bill to pay for 4 years education is $100,000. So they have available 165. So do they have enough to actually give Sasha 100,000? They can easily borrow $100,000 and give it to Sasha for education, and she doesn't have to pay for it right away, right? So she is paying only after she graduates in 4 years, right? So in 4 years, she starts paying, and the student loan back to the family bank is $1,322 per month for 10 years. So she borrowed 100,000 and paid back 158 and $640 altogether, including interest. And they financed 15 vacations from ages 37, 38, all the way till ages 67. 15 vacations, and they borrowed $150,000 because 15 times 10,000 is 150,000, and they paid back with interest 165,960. Doesn't stop there. So third objective is they wanted to help her with the mortgage. So remember, they actually lent her $100,000. Sasha's age 23. That's 11th year of the policies. 297 is available to borrow. Remember, from this amount, they already borrowed 100,000, right? So they, in fact, have 197 available to borrow. So can they borrow 150 and help her with a mortgage of 150,000? It's a down payment of 20%. The house maybe 750. Down payment 20% is 150, and 600,000 she is still borrowing from the bank. But later on, can they recapture this mortgage from a bank? Because see how fast the policy is growing, actually, right? So they can probably easily do that within 10 years. They can actually recapture all this $600,000 from a bank and then put it back into the system. But for now, just let's keep it simple. They borrowed 150, and the $100,000 is still outstanding. So Sasha is paying $1,322 per month for the student loan. And by that time, she may already be married. She may have kids. She wants to buy a house with her husband, and they're actually paying back to their parents for 20 years. They're paying $1,255 per month. That's the mortgage payment. Can they actually extend this payment, not 20 years, maybe 30 years, maybe 40 years, maybe 50 years? Can they do that? Yeah. So for this simplicity, the amount she borrowed for this expense is 150,000, and the amount she paid back in 20 years with her husband, with her future husband, is $301,200. So she paid more actually only as interest than she borrowed. But is she okay with that? Why would she actually pay at 8% if she can borrow from a bank? What is the incentive? Keeping the money in the family, and all this money that she pays, including principal and interest, is actually coming back to her, right? Now, let's see how they actually can use passive income and use the same two policies to receive money tax-free at retirement. So these are their ages. So Mark is 68, Alicia is 67. So remember, they already stopped paying for this policy. They're not paying, right? They decided to retire. Starting from year 31, they collateralize these policies, and they receive tax-free money at 81,000 per year. If you divide it by 2 people, and if you divide it by 12 months, that's actually more than 3,000 per month. They do that for 24 years in a row, And then let's say they pass away both. Mark is 91 and Alicia is 90. And the net estate value is how much they leave behind after this loan is paid off. Remember, this is outstanding loan that they leave behind. But because of the two death benefits they have, the insurance company will actually take care of those loans. And Sasha is going to receive net of this loan $1.7 million. Let's now look at the numbers. So how much did they put into the policies? They put $672,000. How much did they receive back? Let's combine all these numbers. It's actually $1.9 million. And in addition to that, there is a death benefit that is also tax-free, the benefit of Sasha. So summary, family banking system, only two policies. And remember, there's one couple, Mark and Alicia, and there's daughter Sasha, who were using their two policies, right? So there's three borrowers, right? So there's Mark and Alicia are the bankers, and Sasha is a borrower. And in a different example, Mark and Alicia are also borrowers from the same policy. So Mark and Alicia, money in total premiums paid is $672K. Money in as loan repayments is $165,900. So totally, they put money into the system, $837,900 from their incomes. Money out of the system, vacations enjoyed. They actually borrowed $150K from the system, and money out, tax-free passive income. They also withdrew from the system almost $2 million tax-free. So bottom line money out is $2,094,000. If you compare these numbers, money in is $837,900 and money out is $2,094,000. That's 2.5 times more than they've put in. And this bottom line doesn't actually include the two death benefits that will be paid on their death, because this will be in Alicia's benefit, not in their benefit, but it's still in the system. Let's look at the daughter, Sasha. Her money in total premiums is zero because she was not paying those premiums, but she was making student loan repayments. $127,200 is student loan repayments, mortgage down payment repayments. She took a mortgage down payment from the parents, and that's $301,200 into the system. Bottom line money in is $428,400. And money out of the system for Sasha, she received a student loan for $100,000. Money out for mortgage down payment is $150K. Money out for tax-free legacy is death benefits for two parents, net of loans, is $1,732,000. So totally is $1.982 million. That's like 4.5 times more than money in. So every single dollar and every single penny that she pays as a mortgage or student loan, including principal and interest, is actually coming back to her. And that's why she's doing that. She wants to keep it in a family. Total money in combined for Mark, Alicia, and Sasha is $1,266,300. Total money out is $4,076,000 combined, including the death benefits. They created $2.8 million tax-free by only shopping for financing inside the family bank, by keeping it in the family, by keeping it private. So that's $2.8 million was created for the family and in their benefit. Did they accomplish the objectives? Yes, they financed the family vacations for every 2 years, $10,000, 15 times. Yes. Financing Sasha's education, did they complete the objective? And the answer is yes. Helping Sasha to buy a house, $150,000 for down payment. Yes. Passive income at 67 years old, minimum $3,000 per month for each of them, free of taxes till age 91 for 24 years. Yes, in fact, they actually surpassed this number. So they wanted to get $3,000 per month, but actually they get $33.75 per month each. Did they leave a legacy for Sasha for future grandchildren? Yes. Was it taxed efficiently? Yes. So what is unseen? This is what we don't see. So family vacations, all the interest recaptured was, each time they recaptured family vacations was $1,075 for 15 times. That's $16,125 altogether. Interest recaptured that they kept in a family. Sasha's education, interest only is $58,640. That money stayed in the family. Down payment for Sasha's house, $151,200. That stayed in the family. They never lost this money. So total amount of money recaptured was $225,965. And that amount stayed with the family forever and increased all future dividends. who is getting the payments? The money is flowing to the family. So most people don't pay attention and often neglected thing when building wealth, which is death. What percent would you say that you would one day pass away? And unfortunately, the answer is 100%. So everyone is going to pass away at some point, and only good Lord knows when, but we just need to plan for that. Do you think your passing will create tension or stress on your loved ones? Possibly not, but possibly it will at least be hard for them to actually accept that, right? So some families actually get torn apart fighting for their fair share of the estate. Guess what? There is a problem. And the problem is when you become an angel, the government will swoop in to ensure they get taxes from your wealth. There is two things that are 100% guaranteed in life, which is death and taxes. Something called deemed disposition in Canada. So deemed disposition is at death, the government considers all capital property owned by the couple is deemed to be sold, even if it hasn't been sold. But government will deem to be sold at fair market value. So everything you own, bank accounts, investments, rental properties, businesses, whatever it is deemed to be sold. Most of your assets will be deemed to be sold, and there will be fair market value. And if the amount you purchased it for, acquired it for, was lower than the fair market value, then there's a capital gain. And guess what? You need to pay tax on the increase, on the capital gain. So even if you want to transfer the property to your children, they still need to pay taxes on this. And you must pay taxes, your estate must pay taxes within a year, about a year, using only money. And CRA accepts no substitutes for money. Thank you, but no, thank you. They need money. And there is a ticking tax bomb awaiting for the Osborne family to pay this huge tax bill. And so this illustration shows time, but in fact, we don't know how much time is left. So deemed disposition taxes at death, unfortunately, cannot be avoided because they have been legally designed for you to pay. But when you proactively set up the right plan with a coach, and then you plan for this, then this problem can be solved. So do you think the death benefits will help Sasha to pay the estate taxes for the parents? Absolutely. So what do you think she should do with the remaining amount of the legacy? So she received these two death proceeds from the parents. They probably spent a portion of it using the passive income. The insurance company used the death proceeds to pay for the outstanding loans. Now Sasha received this $1.73 million, and she paid the final tax bill from CRA. And I hope that she will have something remaining. In most cases, death proceeds are designed so that it is enough for the family to get something left over. And what do you think she should do with the remaining amount of the legacy? I would actually put it back into the system. She may actually have outstanding policy loans in her system, which is different policy. She may also have additional policies, right? So she may need to pay outstanding loans on her own policies with this cash and open new policies on her family, her children, and business partners. Nelson, in his book, says that you need to create this wealth transfer from one generation to other generation. If this message is taught to succeeding generations, then a perpetual banking system can be achieved. You probably know that the solution is ridiculously simple. Minimize or stop giving your money to the banking system. By virtue of building your own family banking system, you can also minimize the government involvement in your wealth. So gut them out of your life and most limit them when you need to use them, like a debit. What is the best part? The family can stress less. And is it just for vacations and student debt and debt recapture? No, it's for everything. The system can be used for everything. Anything you can think of. Do you need money for charitable giving? Absolutely. This can also be used for anything you can imagine, and even beyond your imagination. I will leave you with this. Creating family bank needs understanding first. Requires discipline to implement the idea, but it can change your life dramatically. So even beyond your fondest dreams. So what is the next step for you? Here's what's required to get started. Text the word schedule to 780-809-4599. And it doesn't matter where you start when it comes to the premium one. You don't have to decide right now, but you need to get started in order to create compounding effect with the policy. When you start, you will feel really good about it. Why? Because It works immediately. You need to set up a time and one-on-one with a coach on our team with authorized infinite banking experts. So it's a lifetime mentoring, quarterly group coaching sessions. Our coaching is free. Our goal is actually not to make you dependent on us, but our goal is to actually help you be independent banker as soon as you possibly can. And now you have two options. First option, you can do nothing. Nothing changes if nothing changes. You will continue to work your butt off for the banks and everyone else gets all your money. Second option, schedule your discovery call, take a hold of your personal finances and put the control back into your hands. Picture a day when financial control is in your hands, not a bank, not the government or risky stock market. When your finances are exactly where you wanted them to be and you know with certainty that you have the freedom to travel when you want to travel, relax when you want to relax, and serve when you want to serve, then it will be a very peaceful state. Have the banking process work for you rather than against you.
If I start a whole life policy, can I borrow money to pay the premium if I don't have the cash up front? Of course, want to make sure you are set up properly right from the beginning. So we're going to make sure that you start off on the right foot so that you don't do that. What is the qualification criteria for the private loan?
The qualification is the loan amount is going to be more than $500 and there's no other criteria. And you need to be in Canada because the money will be only deposited in Canadian bank or sent a check to a Canadian mailing address. If you're outside of Canada, you probably need to transfer this money from a Canadian bank account somewhere else. But if you're living in Canada, you want to stay in Canada, then all you need is just to apply for a loan, and it is as easy as 30 seconds online process. You click the button in the client portal, you answer a couple questions, and 30 seconds, and you applied for a loan. Then you will receive an email from insurance company confirming that you applied, and in about 3 to 5 business days, you will receive a deposit in your bank account that is on file. If you want to receive a check, it will be a little bit longer, maybe a week.
Are all whole life policy equal for every insurance company?
The short answer is no. All whole life policies are different. It's your advisor's job to actually help you set up a policy with the right insurance company that is best suitable. And in most cases, it will be a mutual company. Mutual meaning that there's no shareholders and your advisor will know exactly how to help you. Please talk to your advisor.
When it comes to a whole life policy with an insurance company, it's just as general as, let's say, driving a car. Every car is different depending on the maker, and there's also a design for the car. So for the insurance company, every insurance company is different. We prefer a mutual insurance company where the policy owners are the co-owners of the insurance company. The second part is the designer of the policy, the advisor. The way that we design policies is to practice the process of banking. Those are the two things that will make a difference in terms of this process. If I have a financial advisor looking after my life insurance needs currently, how can you make me gain more wealth?
You know, we respect your relationship with the existing advisor. If he is creating a lot of wealth for you, good for you, but ask him or her how they can actually help you retain and recapture the interest you pay into banks. If it's happening now, good for you. But if your financial advisor is not helping you to recapture interest that you pay into banks, then you may consider working with us.
If this is a process of taking control of the process of banking where you want to be in control, that's where we will step in. Yes, we are using a life insurance product, but it's just the way that we design it, what insurance company we use to place it. And after even designing and placing it, we're here because we practice it in our life, how to use it. That way, at least we can speak from an experiential standpoint to coach you on how to better use it.